Good morning and welcome to our third quarter results where we have this investor webinar. With me, we have senior management, Suboneka Pera, Senior Vice President Corporate Banking, Sanjay Pera, Senior Vice President Personal Banking and Branch Network, Deepal Akuratigama, Chief Operating Officer, Suendani Muthukumarana, Vice President Finance, Sniran Mahavatta, Vice President Treasury, Indika Ranavira, Vice President Business Banking, and Shankar Bewardena, Assistant Vice President Corporate Planning. So as usual, I'll take you through the business overview. So actually this year NDB is celebrating 40 years of service to the nation since 1979. And with the presence of 112 branches, 101 ATMs, of them about 20 offsite ATMs, and also 53 cash recycling machines. And also we offer 80 plus branchless banking network. Our reach has been widened over the last couple of years. And also we opened a second digital branch as well last week at the Shangri-La. So now we have NDB NEOS 2 branches, one in Fort and the other one in Shangri-La. And also through the mobile app, we have been making a lot of presence through the digital channels to reach our clients. So total staff strength is about 2,800. We had about almost 400 staff increase from last year to this year. Of them, about 39% of them are females, and we are the only EDGE certified corporate in Sri Lanka, providing equal opportunity for the gender equality. And this year we also won close to 50 awards, both internationally and locally. And a couple of key highlights are the Best Domestic Bank Award from Asia Money. And also last week we were awarded the Best Digital Bank in Sri Lanka by Global Finance of USA. So of course the bank is quite strong in our governance framework. The board is very well diversified and independent chairman, experienced and dynamic key management personnel, and quite committed to customer service and growing the bank. We have a young and energetic team to drive the growth. So with that, we move on to the assessment of financial performance. So overall, the KPIs for third quarter in a snapshot, year on year, the gross income, 19% growth in gross income, 43.9 billion. And within that, the net interest income has grown by 23% year on year. Fee income and commission income, again, 21% growth to cross 2.7 billion. So as a result, the pre-tax core banking profits, we had 16% growth from third quarter last year to this quarter, the third quarter 2019. So that's 7.1 billion. And then the total operating expenses, again, 16% growth, 7.1 billion again. So the profit after tax, we had 11% growth to cross 7.5 billion. Sorry, 3.3 billion. Profit before tax, 7.5 billion. And the profit after tax, of course, there's a negative growth, 13% negative growth, mainly due to the debt service levy that was introduced. So as a result, the profit after tax was 3.3 billion. And profit attributable to the shareholders was 2.9 billion. And more importantly, on the balance sheet side, we made significant growth. We crossed 500 billion. That was one of the strategy 2020 goals that we set ourselves. And so we have crossed 500 billion and now at 505 billion. So there's 7% growth from December last year to September. In gross loans, 10% growth. to cross 390 billion, and in deposits, 8% growth to cross 374 billion. In the other key ratios, the net interest margin, we are maintained at 3.4%, and cost income ratio around 40.7. Last year it was 39.4, slightly higher, mainly due to the investments in branch expansions and some of the digital expansion arrangements that we did. In terms of performance ratios, the return on equity, it has come down from 17.4% end of last year to 11.8%, but still better than most of the industry performance that have been released so far. Of course, we had a capital raising that was done in the last quarter of 2018. And with that, the ROE has come down because of the denominator that has gone up. Return on assets, it's 1.99, almost 2. So it has come down from 2.2 to 2. And NPL ratio from 2.85% last year, December, it has gone up to 4.93, which is somewhere similar to the industry average, which is also around 4.9 as of September. Of course, the performance compared to last year was impacted by the low growth scenario. The economic activity was curtailed. GDP, as all of you are aware, was very low. Then the industry-wide deterioration in the credit quality. So we also took certain precautionary measures in terms of underwriting arrangements and concentrated on certain other sectors. And also the higher taxes that have been imposed on the banking industry. Effective tax rate is now about 58%. So all that have contributed to relatively lower performance than last year. But despite all these challenges, the core income has grown, as I mentioned, about 21% growth in overall core income, and then the profit before tax level, 11% growth. Moving on to more details on the income side. So the fund-based revenue, you would see that about 24% growth in all sides. Interest income, 24% growth. Interest expense, again, 24% growth. So as a result, the net interest income, again, close to 24%, 23% growth from 10.6 billion to 13 billion in the so this is a quarter-to-quarter comparison, last year up to third quarter compared to this year up to third quarter. So non-fund-based revenue, there again, fee and commission income, we saw 21% growth. I must emphasize on this because this is a challenging area where however, we managed to get quite a good positive growth on fee and commission income. Net gain from trading remains almost the same figure, 767 million. Net gains from de-recognition of the financial assets, again, about 200 million growth, 58% growth to 600 million. The other operating income, that of course has come down from 1.4 billion to 300 million. This is mainly due to the exchange impact. The last year we had quite a substantial exchange gain, whereas this year, with the appreciation of Sri Lankan rupee, the exchange side, there was actually a small exchange loss. So we are comparing a big exchange gain last year versus a small exchange loss this year. So that is the main reason for the drop there. So total non-fund income, there's a 10% decline, but it is 4.5 billion compared to 5 billion last year. So the interest income and the net interest income growth was mainly due to the expansion of the balance sheet. So we had 10% expansion of the balance sheet quarter to quarter. And also we managed to keep the NIM static at 3.4%. So those are the main reasons for the increase in net interest income level. Moving on to the expenses side, again, the personal expenses that has grown by about 14%. One reason is the intake of about almost 400 new staff, plus the increments and all given. But still it is manageable because the cost income ratio wise, we still manage around 40. Depreciation remains almost the same, about 20% growth. Of course, these are mainly due to the investments in IT side and also the digital platforms. But I think there can be more depreciation coming in with some of the investments that have taken place in the second half of this year. Other expenses, there's 19% growth. And overall, the operating cost has gone up by 16%. Cost income ratio, as I mentioned, remains at 40.7%, slightly above 39.4% maintained last year. And in terms of taxation, VAT on financial services, there's 12% increase from 1.2 billion to 1.3 billion. NBT, 185 million. The debt service levy, which is the new one, so that's actually 757 million so far for the 3 quarters. And income tax has gone up again by 22%, 1.8 billion. So total tax paid so far is 4.2 billion compared to 2.9 billion last year. So effective tax rate, as I mentioned, from last year's 43% has gone up to 56%. So this is the main challenge that we are not only NDB or the banking, the industry is faced with. And that basically have a bigger challenge in delivering a higher ROE. So that's something that we need to work on. Moving on to the balance sheet and the asset quality side. The total assets, we passed one of these milestones, 500 billion, so now 505 billion. So year to date, growth is 32 billion, and percentage growth is 7 billion. Year on year, compared to September last year to September this year, the growth is 47 billion. So the year on year, it's about 10% growth. Gross loans, we crossed 390 billion. Again, volume growth of 37 billion for the year. Again, substantial growth came in the last quarter, third quarter. And then the total deposits, again, 26 billion growth to cross 374 billion. Borrowings, roughly about 81 billion. Compared to 84 billion. So it's hovering around 80 billion range. And then the total equity that has gone up by about 2 billion to cross 37 billion. Balance sheet growth, if you compare the industry growth, we have recorded very much above the industry growth rate. In both deposits and advances, you would have seen, I think all the banks have released their results. So when you look at the relative growth numbers, NDB has maintained above average growth in the both the deposits and advances. Impairment side, there's a significant increase in impairments. Last year, quarter 3 was 1.4 billion total. This year, these on the individual impairment side. So that has gone up to 2.1 billion. And the collective impairment, on the other hand, has come down from 1.2 to 561 million. So what we had seen is that more focus on individual impairment side, where we have taken more critical assessment of accounts at the individual level. So that is the reason for the significant growth in the individual impairment. And so total impairments, last year, 3 quarters, it's 2.6 billion versus 2.8 billion this year. So NPL ratio, I think we have maintained it around 4.9%. We have seen the industry in NPL ratios also going up to around 4.9%. However, the NPLs during third quarter, we have managed to contain that compared to the growth that we saw in the first 2 quarters. So that is some positive trend that we have seen. This is some further analysis on the loan book. Currency-wise, roughly 78% of the book is in Sri Lankan rupees, 22% in foreign currency. So that ratio has remained same compared to last year. And the sectorial composition, there again you would see quite a well-balanced pie chart in exposure in all sectors. Agriculture, again, more than 10%. This is one of the regulatory requirements. Then the tourism, which was impacted recently, our composition is only 3%. Even of that 3%, roughly 1% is into Maldives. So they are, again, quite a well-diversified portfolio in terms of industry exposure. Moving on to the funding sources, the key balance sheet growth was funded by increase in deposits and also from the listed debenture issuance that we did in March, where we raised about 5.5 billion. So the current accounts and savings accounts, the exposure remains almost the same. Total CASA base of about 76 billion. Time deposits have gone up from 271 billion to 297. So the overall, the deposit base, 27 billion growth from 348 to 374. So of course, that high growth in time deposit was seen in the first 9 months. But these are again some 3 months kind of deposits. But I think since late, we have taken some 1-year deposits as well, taking advantage of the deposit interest rate cap ceiling that was introduced few months back. So that would naturally help in terms of managing our interest rates in the next year. And we have, but more importantly, what we have seen is the growth that we have observed in the granular deposits, both in term deposits and CASA. The retail network has contributed quite well to this growth in deposits. So that is one positive thing that I've seen. Maybe the corporate side, some of the larger chunks would have moved out, but that has been filled in by a significant growth in retail side. So you may not see a big growth in the CASA deposit because the overall figure is almost the same. However, the retail side growth is quite significant. So these are the granular ones, and these are the ones that the bank should work on. So that is a very positive development. We also raised a listed debenture so to strengthen our Tier 2 capital. So that was oversubscribed, and we raised 5.5 billion in March this year. So these are basically the funding sources to fund our asset growth. In terms of capital and liquidity, the common equity Tier 1 capital ratio, the minimum requirement is 7%. So bank is maintaining 9.5%. Group level, we have 10.6%. Tier 1 ratio, again, minimum is 8.5. We maintain 9.5%. Total capital ratio, the minimum is 12.5, whereas the bank is maintaining 14%. Liquidity coverage, 200%, and also the liquidity, all currency liquidity ratio is also 155, very much above the minimum threshold. And net stable fund ratio, again, 108%. So all in all, the bank is maintaining quite a healthy liquidity position and also capital ratios. With regard to the domestic systemically important bank categorization, where earlier the regulator mentioned that it is when you cross 500 billion, the capital requirements are going up, the Tier 1 going up to 10% and Tier 2 to 14. However, with the regulator making some adjustment to this definition, where in addition to the crossing of the 500 billion exposure, the regulator is also looking at multiple factors such as the interconnectedness, the substitutability, and the complexity of an organization. So given those, they have informed that the high capital requirement is not applicable at the moment for NDB. So we have some headroom to make these capital requirements later on. So there is no need for NDB for the time being for us to raise the capital. Still, the regulator come up with new requirements. So that's in terms of the capital that we stand. And moving on to the investor ratios, the share price, of course, September, the closing price was 97.8, but as of now, yesterday, it has gone up to about 105 range. Earnings per share, 19.2%, 19.2 rupees, and the ROE, 11.8 compared to 17.4. And ROA almost 2% compared to 2.2%. So book value of the share remains almost the same like last year, 106, slightly above last year, 167.9 rupees. And that's where the price to book value, 58%. So that's where the opportunity is. And then the share remains as an attractive opportunity for the investors to invest, given the lower price to book value ratio, which is currently trading at. So basically that covers the presentation, the prepared slides for this presentation for the webinar. So now the webinar is open for your question and answers. So you may raise your questions, and then I will read those and then come up with the answers along with my senior management team. Individual impairment. Okay, there's a question about in third quarter, individual impairments dropped sharply both on year-on-year basis and quarter-on-quarter basis, but the collective impairment increased. What drove this? So the individual impairment for the quarter is, of course, last year 729 million versus 147 million. But if you look at the total year-to-date individual impairment, it has improved. Actually, it has gone up 1.4 billion last year, 3 quarters, versus 2.1 billion this year, the 3 quarters. So what has happened is, yes, the third quarter, the individual impairments are lower. However, there were substantial higher individual impairment that were taken up in the first two halves. So, and then as I earlier mentioned, that we saw some improvement in the NPL side and also the flow of accounts moving to NPL, especially in the third quarter. So that's also the other reason why the impairment, individual impairment for the third quarter is less. But overall, year-on-year to year-to-date, still it is higher than last year, 1.4 billion versus 2.1 billion. There's a question on what's the current composition of loan book, corporate, SME, retail, and project finance, and what's the target composition bank wants to be at end of 2020. Composition, we have seen some significant growth in the retail side, especially in the first the 3 quarters. There are reasons as well. We have strengthened the sales force and also the underwriting standards, and also streamlined the way that we book our loans, especially on the efficiency side, we have improved. Then the card side, again, significant growth. We are across 5.3 billion in card assets. And so that as a result, we are seeing quite a significant growth in the retail side. So which are more granular and touching several Sri Lankans. So you are basically widening your risk base. The corporate side, the growth is not that significant. However, the project finance side, we have seen quite a significant growth. So all in all, this asset mix, we have seen some shift towards retail and SME, but the project finance side has gone up. So compared to last year, slightly increased exposure to the retail sector and the project financing sector. There's a question on to what sectors have the growth in term loans have gone to. So that is mainly coming from project financing. And we had some good growth opportunities in that sector. Plus some of the retail exposures as well, where especially the personal loans, some are given for about 5 years. Plus the housing sector, again, housing, we had some good growth. So these are the three sectors where we had seen growth in term loans. Okay, there's a question on year-to-date loan growth is around 33 billion, while other banks have been sluggish. And where is this growth mainly coming from NDB, retail, SME? So I think I answered that question. Partly retail, partly project finance. And for that matter, NDB also explored avenues in overseas opportunities. So where our project finance and also corporate banking made some headway. So when opportunities in Sri Lanka are limited, now we have taken advantage of our expertise, especially in the project finance, into more into the some of the other entities, especially in the Eastern African region. And that has also helped us to grow our portfolio in the project financing space. Plus the retail banking, we have the largest personal banking customer base in terms of personal loans. And that is a portfolio that we have been growing over the years quite carefully. And that's where we have seen quite good opportunities also to grow. So that has also helped us with the support of our sales staff and also the improvements in the underwriting or approval process that has helped us to improve on the retail growth as well. There's a question on when do you expect the increased capital requirement to be increased for NDB. So we are working on several fronts in growing our capital base. So this is something that we started early this year. So the process is a bit lengthy. Of course, the political developments also are not helping in terms of especially working with investors, the foreign investors and all. So we are working on several fronts, but we are quite confident that we should be able to make this capital infusion most likely before the end of the first quarter next year. So that's the time plan that we are currently trying to work on. So if things goes well, most likely there can be some market announcements as well. But I think we have made some very good progress in terms of working with the prospective investors to raise more capital. Okay, there's a question on, do you think NPL and provision cycles have peaked out? I wish. But yeah, I think when you look at our portfolio, it looks like we have reached the peak, and then that's now it's managing from current level. I don't know about the industry, but I can talk about the NDB. I get a feeling when you look at the portfolio quality, the flow of NPLs, and then the recovery figures that we are achieving, I think that NDB has reached the peak, and then it's a matter of now managing it down. There's a question about our digital branches. What sort of, probably Sanjay can take it, what sort of services are provided in NDB NEOS, and how many employees are working per branch? How many NEOS branches are you planning to open in next 3 years? Sanjay.
Yeah, well, we have 2 branches already. It's paperless for most transactions, I would say, starting from account opening, deposits, withdrawals, all that can be enabled without any paper being signed. And so that's what it is. And then also there is access 24/7 through cash deposit machine that is available. So that has been very successful. And in terms of the expansion on those lines, we will look at strategically where we need to go with this. If you look at the first branch was in Fort, and then when the opportunity came to open at One Golf, we thought that that technology needs to be taken in there. So if we get opportunities like that, selectively we will use this as strategy. And in terms of the staff, yes, about 4 people are working in that branch, instead of a normal branch of about 7 to 8 people.
Okay. So digital branch, so the first one was open in January, and then the second one last week. We have seen some significant headway there. Where there's a set of clients who are patronizing that, and we felt that that's why the location is also selected to cater to the community who are digitally savvy. And we see a lot of opportunities. Not only the digital branch is one side, but I think through the digital channels. For example, the cash recycling machines that we have been installing, or the bank to you proposition, we are seeing quite a good growth. So it's not only having these machines and deploying them, but it is how you execute and how you get reach to these clients. So that is where I think NDB has done quite well. You may have all the good systems, all nice machines to go and install, but it is how you attract clients, how our staff go and get them in. And that's where the NDB has done quite well. They have a very well motivated staff who are going behind, very passionate about delivering this. So that is the key advantage that I think we have compared. And there's the next question as well. Then the next question is, NIM has been steadily improving for NDB compared to the rest of the banks. What is the strategy the bank is currently using? Is it cutting down the previous high cost deposits, or by moving more towards retail SME sector, or both? Now again, I would say NIMs, as I mentioned earlier, it remains same, 3.4%. But slight improvement from last year, 3.3%, 3.4%, when the industry NIMs remain same, or it has come down. But it's more on the cost management side, and again, utilizing the unutilized lines. Say, if you look at the corporate banking portfolio, again, look at what are the ones where the margins are better. So we look at the holistic picture. Sometimes the NIM may be lower, but if the commission or the fee-based income, the overall basket of income is good enough, we apply the RORAC model, return on risk adjusted capital, and use that as a measure to ensure that the overall returns are improved. So sometimes we may improve on our NIM, sometimes we may have to cut down on the NIM but work on the other fee income. So that is why there's 24% growth in both NIM and 24% or almost 21% growth in fee income. So again, staff looking at these opportunities, even training them, providing them training to how to garner the best out of these relationships. So that's one side. The other one is, of course, our focus on retail side, the card base. The card, of course, naturally the rates are relatively higher, margins are higher, fee income is higher. So, and we have one of the best card product that is there in the market. So, and we'll be investing in a new card system. In a couple of months, we'll be moving to a new platform. So with that, there'll be card near right now we are working only on Visa, but we'll be working with Master and the other card platforms as well. So that's quite a good growth plan that we have been driving, and those would come into effect by early next year. Okay, this question, Niran can take it. Please explain how you would manage your NII going forward over the quarter. The improvement is mainly due to the reduction in interest cost. That's question mark. Is it interest cost reduction, or how we are going to manage our NII? So Niran, Treasury.
Yeah, I think it's
No. Okay.
Yes, with the rate reduction, rate caps which were introduced in April by the central bank definitely played a role for our to bring the costs down. But at the same, and which is having a lag effect also, so it will actually have a positive impact on all the banks going up to somewhere around towards the end of this quarter. And what we see is going forward also, I don't think the rates will go up. We expect the rates to remain at the current levels given the current economic situation. So, and we will continue to have we'll be focusing on our cost of funds, which we think that we should be able to hold it at the current level. And even though with the rate caps introduced in your asset side, we feel that with the growth in the balance sheet will offset the yields that which we can earn. So we have a very robust ALCO, which we continuously monitor almost on a weekly basis with the proper assets and liability management. So with that, we feel that we can protect, and actually we will see our NIMs improving going into the next year.
Okay, thanks for that. There's another question on the retail loan growth. Was it focused on any particular sectors? I can take that. Actually, there were no particular sector as such, but of course, as I mentioned earlier, the personal loan portfolio is quite significant. So that has helped because we have a good portfolio. So the top-up arrangements or even those approved company lists where the sales team have been focusing on. So that's one side. These are mostly the professionals, salaried professionals. The other side is on the leasing side. Those are asset backs. And then that's where we introduced about 10 leasing centers over the years. Actually, one reason for the cost escalation is that. However, we are reaping the benefits of such investments by getting more volumes in terms of leasing. Then the housing loans, again, the process was more simplified, and we get a lot of applications coming from even branches. So these are granular housing loans, real housing purposes, not only the apartment financing. So that is again another area that we have seen quite good growth, plus the card business. So I think all those sectors have contributed in terms of the retail side. There's a question on corporates. The question is, based on your discussions with corporates, do you expect corporate credit demand to pick up significantly next year, or will the wait and see sentiment continue till general elections? I'll ask Bhuvaneka to cover that.
Yes. Yes, there were in 2019, the corporate sector business environment was very much lower than the last year of 2018. There were three factors affecting that. The first was, of course, the political uncertainty and the confusion which prevailed during the fourth quarter of 2018, which had a domino effect during the first quarter of this year. Second thing was the Easter Sunday bombing, and which affected most of the businesses, Colombo and around. And the third factor was the current political environment and also the election, presidential election. So almost the entire year was affected by these unforeseen issues. Going forward, with the elections being concluded this month, we are expecting the environment to be more stabilized, and with that, the corporate segment to grow compared to 2019.
Thanks. Okay. There's another question on the interest rate. The question is on with the rate cap in place, is NDB comfortable to lend given that the rate cap does not justify the risk premiums required to lend? Iran, would you like to take it first?
Yes, I think if this actually was told, we mentioned at central bank forums also, this is going to be a very temporary measure. Probably towards the end of first quarter, we may see these lending caps and all that is being taken out. But at the same time, given the position, we still, if we keep our rates low, I mean, like there is no any significant increase in our cost of funds as well, even though the rate cap is not there, given the liquidity position in the market and availability of other source of funds. So we feel that we are quite comfortable that we can maintain the same margin as I mentioned earlier due to these reasons. So and also there's still a little bit of room to play, even though the WPLR is marginally low. The maneuverability is still there for us to manage the cost of funds.
Okay. Right. There's a question on what's the target Tier 1 ratio you are looking to get post the mentioned fund raising. Suppose we are looking at somewhere around 11.5, leaving some ample cushion for future growth. So we are looking at around 11% or even slightly above 11% with the target fundraising. And okay, there's another question: for which sector you have allocated your newly recruited staff? Again, I think that's mainly the front line. We have been maintaining a very tight tab on support functions because several efficiency improvement measures were taken, Six Sigma studies, and then we have deployed robotic process automation processors in several process-related areas. So as a result, we have curtailed the growth in support functions, but most of these staff have been deployed in business-generating areas, especially retail, business banking, where they are generating sales or the new business development. Deepal, you want to add on anything on the RPA process or how we are managing in terms of the efficiencies?
Yeah, so basically as a Chief Operating Officer, I mean, one of my key responsibilities is managing the operation area. So we basically work on two areas. One is on the automation. Another thing is basically on the re-engineering process improvement side. From the automation side, we use two sections. One is the RPA, that's robotic process automation, which is a end-user computing this thing method, and also hardcore systems like workflow systems. So up to now for this year, we have deployed about 10 workflow systems and about 6 RPA systems from the system side to assist the process improvements. And on the other hand, from the process efficiency perspective, we have introduced Lean Six Sigma areas to the bank. And at the moment, we have 26 or 30 Lean Six Sigma certified
staff in the bank. So they are working on continuous basis to improve our, internal processes to make it lean and mean and give the best support to the business.
Okay, thanks. There's a question on hopefully quality. What is the percentage of loans in stage 3 now? As at 31st December, it was 7.5%. Of course, I think we are not required by regulation to disclose quarterly numbers. However, since the question was asked, I will disclose that we are around 8%. So slightly from 7.5%, it has gone up to 8%. Okay, there's another question on bank did not move to systemic domestic DSIB after passing 500 due to change in the way of assessing the DSIB by central bank, which have more criteria. How does they assess other criteria which seems to be more qualitative? Is this coming out in the new Banking Act, which will be applicable, and from when? Actually, that is a question that we will also have. However, the information from the regulator, basically, they say that it's not only the mere crossing of a certain figure. Earlier, the threshold was 500 billion. So there are about 5 banks, including the state banks, are above this threshold at the moment. What I think regulator is looking at is managing a meaningful number of domestic systemically important banks. So if you look at a country like India, they have only 3 domestic systemically important banks. And there are those countries, or even if you look at Thailand, 4 domestic systemically important banks. So those countries have come up with not only the asset threshold, but various other measures. So, for example, the interconnectedness of this particular bank to the system, or else the substitutability, whether somebody else can substitute this entity, or the complexity. So various elements are there. So what I understand from the regulator, they are developing this, they are working on it, and I don't think you have to wait till the Banking Act is, because Banking Act, the regulator has mentioned that it would be enacted most likely by end of 2020, but I think before that, most likely the guidelines on the systemically important banks are going to get released. So by that time, we would have a much more clearer understanding. But the understanding is to manage down the number of systemically important banks so that the regulator can have a more closer monitoring of such banks. So that is the understanding that we have. Okay, that's a question on, do you have a sense of cost income ratio of the neo branch versus a normal branch, and how different is it? Is staff count less? Of course, as Sanjay explained, the staff count is more than 50% less. Normal branch 7, 8, new branch 7, but mature branch is around 10. But in the newest branch, we manage it with 4 staff. So there is a cost reduction on the HR side. However, the initial investments are quite significant. So over the first 3-4 years, the amortization of such capital investments would have an impact on these branches. But what we are looking at is not short-term, the long-term investment, that's the future. So that is why we have been selective in where we are going to have our NEOS branches, where we see there's enough potential. But initial cost is relatively high, but this is a long-term investment. What proportion does the tourism sector NPLs account for? I think that is insignificant. Maybe the tourism portfolio is about 3%, less than 3%. So if you look at the total NPLs, it is less than 3%. basis of That's a question on, could you share some insight on the capital raising for the SIBs? Will it be a case by case or applicable for all new entrants? Any timeline of staggered basis proposed for capital raising? Of course, regulator has mentioned staggered the timelines. Most likely at least a 1 year timeline is given, even if a bank is identified as a domestic systemically important bank. So that had been mentioned earlier. So we're waiting for the guidelines, but most likely, I mean, other countries also have moved to the similar model where there is a staggered basis, step by step, and some timeline given for raising of capital. Okay, that's a question. Again, probably Niran can take it. What is outlook for NIM given the mandated interest rate reduction on the asset side, coupled with the fact that we saw the bank raising FDs at higher rates post the removal of deposit caps?
I think I answered that question earlier, also a similar question. We still feel that the rates are based because the market rates will continue to be around this level or probably even slightly lower going in because of the current economic situation. So we don't expect our cost of funds or the deposit rates to rise significantly. And also given I'm talking about given that the focus on our balance sheet mainly for retail and SME side, we feel that we can continue to keep our margins at the current level or improve on that. And also with the proper assets and liability management and going in for other source of funding also which is available in the market, feel that the NIMs can be defended and improve further.
Okay. Thank you. I think that's all the questions that we have. Anyone else want to raise a question? We have answered all the questions. Okay. So with that, we'll conclude this webinar. Thank you all for your active participation. But we have seen that NDBS showing quite a good growth and also ensuring that the portfolio quality also is somehow managed compared to the industry. As a lot of investments have taken place in the digital front, we are going for a core banking upgrade. On the IT front, there's so many investments. So I think the best is yet to come in NDB. So looking forward to that and would like to thank everybody for your participation. Thank you.